Given the appeals that are being made and the crisis situation that is unfolding in our country, we are very clear that yes, government needs money. But when government needs money, it either looks towards increasing the taxes or look towards borrowing. But we are forgetting about one very important source that comes from RBI. And RBI has just delivered on it, where RBI has transferred 2.87 trillion rupees to the government in form of surplus transfer. Do you think that this will ease out the pressures which were being felt on the economy? If yes, then why stock markets are reacting negatively to this? And if it is going to solve the problems, then how much it is going to create an impact? Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh, and today we are going to understand that why RBI had to transfer money to the government. Is it a usual routine or is it an emergency scenario? What are the legal frameworks around it? And most importantly, how much does it help the situation that Indian economy is looking as of now? So let us begin with understanding the fact that what exactly has happened. So as of now, India's central bank, that is Reserve Bank of India, has announced that they will be looking towards surplus transfer, and that transfer would be about 2.87 lakh crore rupees. Briefly, 2.8 trillion rupees. This is what we are looking at. Now, when we are looking at this sum that is being transferred, this is the surplus transfer that is being made on regular basis every financial year. So, the first question goes out of the picture. This is not an emergency routine that has been invoked. This is something that RBI has been doing. One thing that is new is here that this is the highest ever record transfer that has been made. If you look at this very given graph, you will be able to clearly see that the surplus transfer is highest till dates, and the problem here is when we are looking at the highest surplus transfer ever, then why stock markets have reacted differently to it? I'll be answering that as well, but till then let me know what are your thoughts about it, that why do you think stock market, financial markets did not like the surplus transfer that has just happened. But when we are trying to understand that what exactly is happening, we need to break it down from the start. So let us start with understanding that what exactly is a surplus transfer, or what we call RBI dividend. So when we are looking at central bank has multiple operations that it performs. Now the profit that it makes of those operations, it transfers it to the central government, keeping some money aside. So once RBI has kept enough money for safety reserves, the remaining surplus is transferred to the government. Now the question is, if RBI is earning from financial operations, what are those financial operations? So let us understand what is the source of income for RBI. So first of all, we clearly know that RBI is responsible for issuing the government bonds, right? So when RBI is looking into the management of issuing the government bonds, all the interest that is earned on these bonds and securities, that is present with RBI, that is a source of income. Then when we look at RBI managing the Forex exchange reserves, we clearly get to see that RBI invests in US Treasury bonds, RBI invests in foreign securities, and there are central bank deposits which are also maintained. Now these investments bring returns. Who will keep these returns? These returns are kept by RBI. This is another source of income. Then when we are looking at keeping the Forex reserve, we also know that RBI is directly involved as an entity in foreign exchange market. So the operations that RBI carries out, they also help in getting income. How? Let's just say RBI bought dollar when it was 80 rupees. Now when RBI has to sell dollars and put it in the market to stabilize the demand, the price as of now looks 95 rupees. There is profit. So this is also another source of income. And then RBI is responsible for managing the monetary policy across the economy, which includes the liquidity in the banks, the repo rate operations, reverse repo rate and everything. So when they are lending to the banks, that also generates interest incomes. So we have established multiple sources of income are present with RBI. Whatever profit RBI is making, RBI keeps some buffer so as to ensure that there is enough safety reserves with RBI as well, and then transfers this dividend, the surplus transfer, to the government. Now we are clear with what is surplus transfer. Now let us move to understand that why this is very important, and why when we are looking at RBI surplus transfer, RBI dividend, this adds a boost to the economy. So first thing we have to understand that government always has a expenditure at hand, and when we are calculating the fiscal deficit, it is broadly calculated when we look at government expenditure minus what government is getting in terms of revenue. But please remember, when we are looking at the revenue part, we are excluding borrowing. Whenever you are looking at the formula of fiscal deficit, this is a very important component that you need to remember. Now, if the government's expenditure is high and government revenue is low, in that situation, that is a problem. If government wants to reduce this deficit, government needs help. So either government will increase taxes, which will have repercussions on the economy, or government will borrow, which will also have repercussions on the economy. So in this context, when you look at RBI dividend, this is a non-tax revenue, and when government adds to it, it helps in reducing fiscal deficit. This means that government can think of spending the money better ways and not be worried about certain amount. In this year, it is 2.8 trillion rupees. And this is what exactly helps in supporting the government spending. How? If you look at the present situation, let's take the example. We are seeing that there is price hike in terms of fuel. If government wants to make fuel tax cuts, the government can do so. The fertilizer subsidies in the given context are a problem because fertilizer prices are rising because of the Iran war crisis we are seeing. So if the subsidies are also increasing for the government and government needs support, the support is right here. If government wants to continue on the welfare expenditure, the government can do so. And if government needs help in absorbing the oil price shock, this is where the help comes from. So all of this will lead to help in stabilizing the economy, that will be lowering the borrowing pressure, lowering the pressure to increase taxes. There will be better bond market confidence, the government bonds which are released, and the government which is being pressurized, central bank which is also seeing pressure of revising the interest rates, that will also see some respite. So overall, this comes as a huge help to our economy at this point of time. But you must have the question that we started with, that why it is not showing in terms of investor sentiment, why financial markets are going down, they have not reacted very well to this number. We'll come to that, don't worry, we'll be discussing that. Now, when we have understood why RBI dividend is important, another factor that we need to consider right here is what allows this framework. That why RBI dividend is existing in the picture, what is the legal framework behind it. So the major framework comes from the RBI Act of 1934 itself. The section 47 directly talks about that RBI will transfer surplus profits to the central government of India after the provisions have been met, depreciation has been addressed, and emergency reserves have been kept aside. So this is where the main framework is coming. There is additional two things that you need to remember in this context. The first one is the economic capital framework. Now this framework was conceptualized in 2014-15 and then later operationalized in 2015-16. Now this is where it talked about that how central bank needs to have proper reserves in order to ensure that the shocks or the emergency situations can be made sure or managed with. So this is the main framework which was created to understand that how much RBI will keep with itself and how much RBI will transfer. But this framework saw a major revision after the Bimal Jalan Committee of 2019, and they made two very important recommendations. That RBI should maintain a contingency reserve buffer, and when we are talking about this buffer, Bimal Jalan Committee recommended that it should be between 5.5% to 6.5% and it should be subjected to revision every 5 years. And whatever is excess beyond this can be transferred to the government. Now, this is where we get to see economic capital framework coming into the picture, but this has been discussed since 1997. Three very important committees which have talked about this: Usha Thorat committee is present, Y.S. Milgam committee there is present, and also the V. Subramaniam committee should be remembered in this very context. Now let us move to consider that when we were looking at the very first thing, that this is a record number that we have achieved at present, what is facilitating this number? Don't get exhausted, we will discuss the point that even if it is a record number, why it is determining the market in a different direction. So the reason we are getting to see that RBI's dividend is increasing, the surplus transfer is increasing, it has to do with certain positives and certain negatives. A negative such as rupee depreciation. Now RBI earns more rupees with every dollar. So this is not such a positive thing, this is a negative. Second, RBI has maintained large forex reserves. As of now, we have import cover of 11 months. If you look at the starting of this year, we had import reserves as huge as $709 billion worth. But over the next 3 months, 4 months that we have seen, because of the crisis emerging from Iran war, there have been a lot of usage from this. But at the same time, when we are looking at the number somewhere around $640 billion at present, this is also big enough to generate huge returns. Now, another factor comes from the global dimensions. This is where we need to look at how certain economies are delivering on better interest rates. In this context, US also needs to be considered. So, when we are looking at US Treasury securities where we have invested, better returns are present. And a bigger factor, which is also another negative that we have to understand, that this time the contingency risk buffer, which is to be maintained as per ECF, that is Economic Capital Framework, that RBI has reduced. RBI kept it 7.5%, RBI has reduced it to what? 6.5%. Bimal Jalan Committee talked about 5.5 to 6.5, but RBI maintained buffer between 4.5 to 7.5. That is why we see that a bigger amount or the highest amount has been transferred to the government. But this amount is still not enough to make financial markets happy. The reason here is it was expected that the amount would be way higher. When we are looking at 2.87 lakh crores, the market expected that this amount would be somewhere around 3.2 trillion rupees. Because the dividend is lower than the market expectations, that is why market has shown negative sentiment in this place. Another thing that we have to understand that is creating a huge concern is the bond yields. Bond yields have increased just after this announcement. That means in this scenario, bond prices will go down, because I think we are clear here that bond yields and bond prices have inverse relationship. Let me know in the comment section if we need to discuss this in detail. We can probably pick it up in detail in another video. Another huge market concern in front of us is the fiscal deficit itself. Yes, it helps, it supports the government, but if we are looking at trade deficit of last month itself, let us take an example to understand the situation. Fiscal deficit is still present, but RBI amounts help in there. But if we look at the situation, for example, when we are looking at trade deficit of last month was also record high. If we want to help the trade deficit, which is a different component, trade deficit is coming from balance of payment. Please remember, when we are talking about fiscal deficit, it is coming from the budget expenditure. But at the same time, when government needs help there, what will fiscal or the increased revenue do? Nothing at all. At the same time, the government expenditure, it is rising at such a fast pace. Given the higher subsidies, given that tax cuts are, given the margins of the PSUs are going down, this range is increasing every day. And there are further more bigger economic implications, such as the RBI surplus is definitely a good news, but dependence on it is problem. Subsidy burden is still increasing, that means fiscal deficit still remains. And most importantly, that we discussed in detail yesterday, most importantly, is the weakening rupee. The worrisome part is we have touched a yet another historic low, that is of 96 rupees is equivalent to $1. Certain positives can also be seen in this situation, that there is some support, the borrowing pressure has reduced, and there is some extra revenue. But overall situation remains tight and difficult for the government, and RBI surplus might have given a breather, but it is not the solution at all. What are your thoughts on this? Let me know in the comment section. I'll be leaving you here with the prelims practice question. Let me know the answer to this in the comment section. I'll be waiting for your answers. That was all from my side. Thank you so much.